Hey everyone, we hope you're having an awesome start to your new year. And as always, Michael and I like to do, well, we do this more than once a year. And I think we wanted to call this Q&A with your CFA, but it's changed over time. I think Matt did it last year, didn't he,
Yeah, I think Matt
Michael?
and I had a conversation back in October about this.
Yeah, and it's always fun to revisit the year with you, revisit the quarter with you, talk about the expectations for things forward looking going into this new year. And I think our goal is to keep this relatively short, 10 to 12 minutes. And then if anyone wants to have more commentary or read more into it, Michael's actually putting a really nice piece together that's going to come in connection with this video if you've received this via email or you're checking out our social media. So Michael, let's jump right in. Wild year. Like we were just talking about this. I can remember doing banking crisis commentary with you. That felt like 4 years ago. That wasn't even 10 months ago now. And yet the markets ended up pretty strong by the end of the year. What
Yeah, I don't
happened?
know if you remember this, John, but back in April we did a talk for a group in Orlando, and initially we were asked.
Shout to Rotary. Come on.
Yeah,
Shout out to Rotary, Orange County East.
I didn't want to give my mom away here because we were booked through her and a couple other people, but we were giving a talk. In the beginning, we were booked to talk a little bit about Canterpath, who we are, what we're doing, and some timely topics. And that was in January when we were booked. But by the time April rolled around for us actually to talk, the financial markets were in disarray. We had four different banks teetering on the edge of insolvency. So Silicon Valley Bank and First Republic, no, I take that back, not First Republic. Silicon Valley Bank and Signature Bank were
Mm-hmm.
already on the brink of insolvency. Credit Suisse was looking like it had problems, and First Republic was teetering on the edge. It took a couple more months for Credit Suisse and First Republic to ultimately be orderly tucked into other banks. They did not fail, they were sold away. But Silicon Valley Bank and Signature Bank failed. And we had the opportunity to talk through what exactly happened. Why did these banks have issues? And if you remember, it wasn't necessarily that the banks themselves had problems as much as it was just human mismanagement, identifying maybe it wasn't a good idea to make 2% loans for 30 years, your deposits, which were not sticky for them.
Mm-hmm.
And there's a lot that's in there, but a lot of that was mismanagement by the banks themselves. But when we also had that conversation, we talked about, does this moment in time pose a question for us? Like, is it a good time to invest or is it not? And when we left that meeting, we wanted to share to everyone that yes, it still was a good time to invest because every year there seems to be different events that occur that can sideline investors. And 2023 overall was no different than any other year. So if you remember coming into the year, we had the Russian invasion of Ukraine. We marked 2 years of that. So we had a war in Europe. We had four different banks failing. We had war in the Middle East by October. We also had multiple labor union strikes. If you forgot, there was a government debt limit showdown at some point around these times. And we were facing high inflation and high interest rates.
Those are
And
7 events. I mean,
yeah,
obviously a
I
lot of
can
those are
keep going if you
interconnected.
want me to. Like,
Well, I know that's what was so fun on the pre-call when we were talking about this. I mean, that is 7 different major things that if any one of those happened in a year, those could be a problem. 7 things happened in one year. And yet here we are at the beginning of the new year going, wow, the markets actually did really well after all
yeah,
that.
if I told you or I told anyone listening that all those things were going to occur this year, and the Dow was going to hit a new all-time high, and the Nasdaq and the S&P were within scratching distance of their all-time highs, would you take that?
Mm,
Because
yeah.
a lot of investors last year didn't. I mean, they sat on the sidelines. Do you remember in 2023 the concept of T-bill and chill?
Hmm.
So, coming into the year of 2023, everyone widely expected to have a recession of some sort. And with the Federal Reserve pushing up interest rates to fight inflation, for the first time in a long time, you could get a decent return from treasuries. So a lot of people or a lot of investors, I should say, were sitting in treasuries for the entire year. And they're thinking, I'm going to make 4 or 5%. At some point, the bottom's going to fall out of this market. But it never happened.
Mm-hmm.
And actually, the opposite happened. Like the NASDAQ rallied over 40%. The S&P was up 26, and the Dow finished the year up 16. Even bonds participated. The aggregate bond index was up 5. High yield bonds were up 13. After a dismal 2022, if you just held on and stuck to your asset allocation, 2023 worked out for you. Now, I'm not saying that you were made 100% whole or that everything's okay, right? 2022 stunk. But 2023 was everything that 2022 wasn't, and more for a lot of people, as long as you stuck to what you were doing.
I think it's easy to talk asset allocation when you're framing it in longer term stretches as well, like 5 and 10 years. But the past 2 years have been a microcosm of, like, it's such a great example of why you stick to that asset allocation. And I don't want to get preachy on this call, but a lot of the conversations and meetings we have with clients throughout the year are, here's our investment policy statement. This is why, talking through the rhyme and reason of the allocation and the stocks and the bonds and the weightings that we have for a client. And you go through the last 2 years and you can reflect back on those past 2 years and go, oh, gotcha. That's what, like, it's easy for me to look at that and go, yep, that is exactly why. And I think it's important to have examples like that, because I mean, I can remember even second half of last year, going through like September, October, having conversations about market volatility. But then the last couple of months really rallied to where now we're sitting at the beginning of January, having a much different conversation with folks than we were just a few months ago. It's so interesting.
Asset allocation is important because, and again, like, not to get preachy on this, because we can spend an hour on this subject just itself.
So we do. We like it.
It's important because the asset allocation you pick is not just for the good times, right? Because we all like to see the market go up. If that was the case, we would all be 100% equity 100% of the time. But your asset allocation is really there for the years like 2022, when the market's down and you stomach this because you know that these things don't last generally. Looking at the markets, They don't last. Markets turn around. So when you pick the asset allocation, it's not necessarily a thing that you change. Like, you don't get more conservative when the market goes down. The time to get more conservative was before it happened. And if you weren't comfortable with where you're at, decisions should have been made before then. If anything, you get more risky at that point because the market turns around. It never pays to bet against the U.S. economy. And I think this year showed that for a lot of investors that maybe were shaken out of the market and looked at it and said, you know what, 4 or 5% zero risk, I can make that. And you know what, for those investors, that's fine. And there are a lot of people that makes sense for. But for everyone that's stuck in there, 26% on the S&P 500 is not bad.
Right. Exactly.
Not bad at all. And when we think about what's going to happen for 2024, who knows? Real, right? Like, if I had that crystal ball, you and I would be sitting on a beach somewhere. Yeah. We'd be playing with our day trading on the beach somewhere. But realistically, anything can happen in 2024. If you told me, Michael, going to 2023, banks were going to fail, I think a lot of people would look at you and be like, that's crazy. Like, the banking system is so well capitalized. But what is failed to be understood in those analysis is that there's a human factor, right? There was nothing credit wrong. When I say credit wrong, I mean Signature Bank, Silicon Valley Bank weren't making bad loans. The people they were making their loans to were responsible humans, but there was a duration risk to them. The longevity of a mortgage that they loaned against their short-term deposit was a human mistake. And it was a mistake not to hedge that. And that is something that you can't get away from. So when we move into 2024, the coast looks relatively clear, right? Like, inflation's at 3.1%. Unemployment's below 4%. The economy's chugging along. And it's not like an economy just falls off a cliff. There's momentum that's involved. Like, you don't You don't go from a 5% GDP growth to negative GDP growth the next quarter unless something wild happens like COVID. It just, you can't just stop a train on a dime, which is what we're looking at.
What do you say to the folks that would reply to that with, "Yes, all that's great, but it's an election year"? What would you say
I
to
love
that scenario?
election years because
Okay.
because it's psychology matters, right? And maybe we should do an entire conversation on this, but JP Morgan has some very interesting data on this. And the psychology of election years and how people feel about the economy is dictated often by their political beliefs, right? And it's very interesting to look at a a graph of sentiment by political parties. So, and I wish I could pull it up right here, but we may maybe better serve talking about it at a different time. But from the years of 2000 to 2008, Republicans by and far thought that the economy was doing well. I mean, there was a period from 2007 to 2010 when we all agreed that it sucked. But
Right.
by and large, Republicans thought the economy was doing better than Democrats. There was an election in 2008 and a Democrat won. And from 2008 to 2016, Democrats, by and large, thought that the economy was doing much better than Republicans did. And in 2017 to 2020, it flips on a dime again. It's
Yeah.
wild how this happens when a Republican wins. Republicans felt that the economy is doing better. Our political beliefs act as filters for us, right?
Mhm.
So in 2024, yes, there's going to be a lot of volatility. Anything good that happens, both parties are going to shoot for it. Anything bad happens, both parties are going to push it against each other. The reality is that the economy and the markets both go up under Republicans or Democrats, and it goes up under a divided government as well. We just intake the data differently based on our political beliefs. And
Yeah. Not to mention the fact that if there is any short-term volatility leading up to an election, that doesn't dictate long-term planning and
no,
strategy anyway.
really, the market doesn't like elections because of the uncertainty, right? Like leading up in October, you could see some market volatility because, and we could get into like what happens if the Republicans take everything or the Democrats take everything, what could happen, and maybe we do that recording. But the market doesn't like the uncertainty. As soon as the market knows what the rules are, it figures it out and moves forward. It's the uncertainty that they don't like. But
Yeah.
when they know what the rules are, or when we all know what the rules are, we just move forward and we play by them.
I think we do. I think we will record that because that will be very interesting. And one of the things that Michael, I know you do this in meetings too, but we're talking about current events and what's going on in the world. And sometimes in between meetings that we have with clients or update calls or emails, like we want to be able to deliver commentary, maybe in between a time that we would normally talk with them. So I think it'd be great to do that because those are going to be the conversations
Yeah.
that we're going to be having the second half of this year. Michael, as we wrap this recording up for our clients, is there any final parting words of wisdom you'd like to end this session on?
Yeah, it's I'm looking at the date right now. It's January 5th, and I've had a couple client meetings already this year and a couple meetings in the week after Christmas before New Year's. And the same question has been posed in every meeting. What does 2024 look like, and do we need to make changes to our investments? I.e., is now a good time to invest? And in any given year, we can point to reasons why we should not invest. But in any given year, we are proven wrong to not do that. It's essentially, yes, it's a good time to invest for a long-term investor. If you are day trading, if you are trying to make swing trades and be very tactical, maybe you sit on the sidelines for a little bit. But if you're a long-term investor, which is the people that we're talking to, our clients, who we work with, it's a great time to invest. I mean, the American economy is fantastic. Are there problems? Yes. Are there things that we have to confront? Absolutely. But in our history, things have been much worse before. It's really not that bad today. So,
Well said.
Well said. Everyone that's looking at it, yes, it is a good time to invest. Could there be hiccups? Absolutely. But still feel confident about the future and still feel great about 2024.
Yeah, I love that point. And I think that for the folks watching this video that obviously want more commentary, along with this is going to be Michael's the latest blog where, I mean, I got to give you some kudos here. Like, Michael is such a gifted writer, because one of the things about CFAs in our industry is they have a tendency not to be able to connect well with clients and analogies and making things simple to understand. Michael, you do an amazing job at that, which is why I always enjoy these Q&A with the CFAs. I'm going to make that tagline stick. I'm going to make it stick.
Let's make it stick.
So hopefully later this year, you and I will do another one on the election. And thank you all for listening, and obviously reach out to us if you have any questions. We'll see you later.
See ya.